Welcome to my channel, where I dive into the world of finance and accounting. In this video, I'll be exploring three crucial categories of financial ratios: liquidity ratios, efficiency ratios, and more. These ratios help investors, analysts, and business owners understand a company's financial health and performance. Let's get started. Liquidity ratios measure a company's ability to meet its short-term obligations without facing financial distress. So, as a measure of liquidity, we shall consider the current ratios. Current ratio. This ratio indicates whether a company has sufficient current assets to cover its current liabilities. It indicates whether a company has sufficient current assets to cover its current liabilities. I repeat, current ratio indicates whether a company has sufficient current assets to cover its current liabilities. So, in accounting, we have two currents. The two currents we have is current assets. That is the first one. And the second current is current liabilities. Current liabilities. So, as I've said, we have two currents. Number one is current assets, and the second one is current liabilities. So, the ratio of current assets to current liabilities is current ratio. And for this ratio, we have an acceptable threshold. The threshold is ratio of 2 to 1. The current assets must be twice the current liability for a business to be liquid. So when current ratios are used as a performance measure. Then the second ratio that can be used to measure the company's liquidity is quick ratio. Quick ratio or acid test. Acid test ratio. Acid test ratio. Quick ratio or acid test ratio. This ratio indicates whether a company can meet its current liabilities without relying on the sales of inventories. So, it indicates whether a company can meet its current liabilities without relying on the sale of inventories. So that is quick ratio. So that is why it excludes inventories from its measurement. So quick ratio is current assets minus inventories over current liabilities. Current liabilities. Current assets minus inventories over current liability. That is quick ratio. The third ratio we shall examine under this category of ratio is cash ratio. Cash ratio. Cash ratio indicates whether a company has sufficient cash reserves to cover its current liabilities. It indicates whether a company has sufficient cash reserves to cover its current liabilities. Therefore, cash ratio is ratio of cash and cash equivalent. Cash and cash equivalent over current liabilities. Current liabilities. Cash and cash equivalent over current liabilities. And the fourth ratio I will examine is operating cash flow ratio. Operating cash flow ratio. Operating cash flow ratio. This indicates whether a company can generate sufficient cash to cover its current liabilities. It indicates whether a company can generate sufficient cash to cover its current liabilities. So operating cash flows ratio is operating cash flows over current liabilities. This is the ratio of operating cash flows to current liabilities. So we have that to be operating cash flows over current liabilities. Operating cash flows over current liabilities. Having examined the liquidity ratio, I want to consider the efficiency ratio. Efficiency ratios. Efficiency ratios. Efficiency ratios measure a company's ability to manage its assets, liabilities, and resources efficiently. It measures a company's ability to manage its assets, liabilities, and resources efficiently. Under this ratio, we have asset turnover ratio. Number one, asset turnover ratio. Asset turnover ratio. Asset turnover ratio measures a company's ability to generate sales from its assets. It measures a company's ability to generate sales from its assets. So asset turnover ratio indicates whether the company is using its assets efficiently to generate revenue. It indicates whether the company is using its assets efficiently to generate revenue. For this ratio, the higher asset turnover, the better for the organization. Where the asset turnover is high, it indicates that the assets are used efficiently to generate revenue. So asset turnover ratio, that is the ratio of revenue over capital employed. Capital employed. So in my first video on ratio analysis and interpretation of financial statements, I've examined what capital employed means. I've told you, you can say capital employed is total assets. And if you see it to be equity, where the business is financed with only equity, then that means capital employed will be equity. And if the business is financed with composition of equity and debt, that means capital employed will be equity plus interest bearing loans. So all this were explained in my first video. Please try to watch the first video for better understanding. My first video contains all the performance ratios, and in fact, a standard question was solved from the past ICANN exams. Number 2, we have inventory turnover ratio. Remember this asset turnover ratio, you can compute it asset turnover period. You can have your result in period. If it is in period, you multiply by 365 so that the answer will be in days. So the second ratio, we have inventory turnover ratio. Inventory turnover ratio. Inventory turnover ratio. Inventory turnover ratio measures a company's ability to sell its inventory. It measures the ability of a company to sell its inventory. How frequently can an entity turn over their inventory? If they are finding it difficult to turn over their inventory, that means they are dealing in a slow-moving items of inventory, or maybe they charge the price that is too high for their items. So inventory turnover ratio indicates whether the company is managing its inventory efficiently. So it indicates whether the company is managing its inventory efficiently. For this ratio, the higher, the better. So inventory turnover ratio is cost of sales over average inventory. Average inventory. Cost of sales over average inventory. The results obtained could be expressed in times. X times. So that is for inventory turnover ratio. Then the third ratio we shall examine is inventory holding period. Inventory holding period. Inventory holding period. This measures the average number of days the company holds its inventories. It measures the average number of days in which a company holds its inventory. So the ratio is a reciprocal of this one. So that means the inventory holding period will be average inventory over cost of sales. Cost of sales. Since it is in period, we have, if you want to leave your answer in days, you have multiplied by 365 days. In a year, we have 365 days in a year. And if you want to leave your answer in months, we have 12 months. You multiply by 12. And if it is in weeks, then you multiply by 52 weeks, unless stated otherwise. For this ratio, the higher, the better. Then number 4 ratio that can be used to measure the entity's performance is trade receivable collection period. Trade receivable collection period. Trade receivable collection period. This measures the average number of days a company takes to collect its receivable. It measures the average number of days a company takes to collect its receivables. For this, the lower will be better. If it takes too long, that means the entity's receivables are not easily realizable. The entities are not collecting their money back from their credit customers. They are not collecting it back on time. And when this increases, then the incidents or the bad debts would increase. So that means there will be higher bad debts where there are higher receivable collection period. So receivable collection period is average receivable over credit sales or credit revenue. And we have 365 days in a year. Remember, I've told you the lower is better for the entity. So that is for receivable collection period. I've told you where it is high, then loss of the receivable will become bad. That means the bad debt will also increase, where receivable collection period increases. Number 5, we have trade payables payment period. Trade payable payment periods is the number of days the credit suppliers remain unsettled. How long does it take you to pay your suppliers? That is known as trade payables payment period. Remember, if the payment due to suppliers, if it is delayed unnecessarily, Suppliers may not be willing to extend further credit to you. And if you do not have cash to pay for goods bought immediately, that means you might run out of stocks. And you know the consequence of stock outs. So I've told you the longer the better, but you should remember that it's not equally ideal to delay the settlement of the credit suppliers unnecessarily. So to calculate the trade payable payment periods, that is average trade payables over credit purchases. And where the purchases are not available, you may make use of cost of sales. If purchases are not readily available, you use cost of sales times 365 if your result is in days. But if you want to get the result in weeks, you multiply by 52 weeks. And if you want to get the results in months, you multiply by 12 months. So that is the trade payables payment period. Having examined the liquidity and efficiency ratios, so we want to take a question from ICANN May 2024 corporate reporting question number 1. Watch this video to the end for better understanding. Example. This question is obtained from ICANN May 2024 corporate reporting question number 2. Alpha PLC is an entity which has grown in recent years by acquiring established businesses. Alpha PLC is contemplating acquiring Beta Limited and Gamma Limited. Alpha PLC, Beta Limited and Gamma Limited operate in the same industry. Alpha PLC believes that their company shareholders will be receptive to take over. The management of Alpha PLC has indicated a total 100% acquisition price of 12 million naira for each of the companies. The financial statements for Beta Limited and Gamma Limited are as shown below. We have the statement of profit or loss for the year ended September 30, 2020. We have for Beta Limited, and then we equally have Gamma Limited. Amount is in 1,000 naira. Revenue 25,000, which means 25 million. Revenue for Gamma 40 million. Cost of sales for Beta 90 million. Gamma 32.8 million. We have gross profit of 6 million and 7.2 million for Beta and Gamma respectively. Distribution costs 800 for Beta Limited and 1.4 million for Gamma Limited. Administrative expenses 450,000 and 900,000. Finance cost of 250,000 and 900,000. Profit before tax 4.5 million and 4 million for Beta Limited and Gamma Limited respectively. Income tax expense 900,000 and 1 million. Profit for the year 3.6 million and 3 million. We have statement of financial position as of September 30, 2020. Beta Limited and Gamma Limited amount is in 1,000. We have no current assets, which include property, plant, and equipment. The property, plant, and equipment comprises property for Beta, nil, Gamma 3 million. Owned plant and equipment, Beta 4.8 million, Gamma 2 million. Then leased plant and equipment, Beta Limited, nil, Gamma Limited is 5.3 million. We have the total of the non-current assets of 4.8 million and 10.3 million for Beta Limited and Gamma Limited respectively. Then we equally have current assets. The current assets it comprises cash at bank and in hands of 1.6 million and 200,000 respectively. Trade receivables of 1.6 million and 5.1 million. Then inventories of 1.6 million and 3.4 million. The current asset is totaled 4.8 million for Beta Limited and 8.7 million for Gamma Limited. Total assets of 9.6 million and 90 million for Beta Limited and Gamma Limited respectively. Equity and liabilities. Equity comprises ordinary shares of 1 naira each. Beta Limited is 1 million, while that of Gamma Limited is 2 million. Then we have revaluation surplus on property. Beta Limited is nil, Gamma Limited 900,000. Retained earnings 1.6 million and 2.7 million for Beta Limited and Gamma Limited respectively. Total equity of 2.6 million and 5.6 million for Beta Limited and Gamma Limited respectively. Non-current liabilities. It comprises finance lease obligation for Beta Limited nil, Gamma Limited 4.2 million. 5% loan notes. December 31st, 2026. Beta Limited 5 million, Gamma Limited nil. 10% loan notes. December 31st, 2026. Beta Limited nil, Gamma Limited 5 million. Then the total of the non-current liabilities of Beta Limited is 5 million. That of Gamma Limited is 9.2 million naira. Current liabilities. It comprises trade payable. Beta Limited 1,250,000. Gamma Limited 2.1 million. Finance lease obligation. Beta Limited nil, Gamma Limited 1 million. Tax payable. Beta Limited 750,000. Gamma Limited 1.1 million. Total current liabilities. Beta 2 million. Gamma 4.2 million. Total equity and liabilities. Beta Limited 9.6 million. Gamma Limited 90 million. Additional information. Beta and Gamma Limited amount in 1,000 naira. Note 1. The carrying amount of plant. So we have the carrying amount of plant, and the first one is owned plant, and the cost of the owned plant is 8 million for Beta Limited and Gamma Limited 10 million. Less government grant. Beta Limited 2 million, Gamma Limited nil. So you have net amount of 6 million and 10 million respectively for Beta and Gamma. Accumulated depreciation. Beta Limited 1.2 million, Gamma Limited 8 million. Carry amount is 4.8 million and 2 million respectively for Beta and Gamma. Leased plant, original fair value. Beta Limited nil, Gamma Limited 8 million. The following ratios have been calculated. We have Beta Limited and Gamma Limited. Gross profit margin 24.0% and 18.0% for Gamma. Profit margin before interest and tax 19.0% for Beta and 12.3% for Gamma. Return on capital employed 62.5% for Beta and 31.0% for Gamma. Then notes. Finance lease obligations are treated as debt. So finance lease obligation is debt. That means it will be included in the calculation of capital employed. The current ratios. For Beta Limited 2.4, ratio of 2.4 to 1. Gamma, ratio of 2.1 to 1. Asset test ratio. For Beta Limited, ratio of 1.6 to 1. And Gamma, ratio of 1.26 to 1. 1.26 to 1. Net asset turnover of 3.3 times for Beta Limited and 2.5 times for Gamma Limited. Then note, taking as same figure as capital employed. That is, same figure you use for net asset turnover is the same. That is the same definition for capital employed you have here, which is equity plus debt. So that same definition will still be applied for the calculation of net asset turnover. No, net asset turnover will not be revenue over capital employed. That is what that means. Then closing inventories holding period 31 days for Beta Limited and 38 days for Gamma Limited. Then we have trade receivables collection period 31 days for Beta Limited, for 7 days for Gamma. Trade payable payment period using cost of sales 24 days for Beta and 23 days for Gamma. GRA, that is ratio of debt to capital employed, which is debt plus equity. Debt over debt plus equity, that is the definition of GRA. That is the formula, which is 65.8% for Beta Limited and 64.6 percent for Gamma Limited. Required. Write a memo. You are to write a memo to the director of Alpha PLC, advising him on how to make investment decisions, considering the performance and financial position of Beta Limited and Gamma Limited for the year ended September 30, 2020. Solution. You are to write a memo to the directors of Alpha PLC. So your memo, you start with 2 directors of Alpha PLC. This memo is coming from who? From you. And who are you? You are the financial controller. Financial controller. Then after that, you may put date. Your memo must be dated. Date. You are writing the memo. Let me say December 31st, 2025. Then, what is the subject? The subject. That is the purpose of the memo. If you look at the requirement, you are to write a memo to the directors of Alpha PLC, advising him on how to make investment decisions, considering the performance and financial position of Beta Limited and Gamma Limited for the year ended September 30, 2020. So that means your subject should be investment decision. That is, you want to compare the performance of Beta Limited and Gamma Limited. So you can put investment decisions. So let me put column. That is, you want to compare the performance of the 2 companies, Beta Limited versus Gamma Limited. Let me put Beta Limited versus Gamma Limited. That is, you want to compare the performance of this company and then decide the one to choose. So your memo, you will start with introduction. Introduction. So what do you want to do? I've told you your introduction should always start with the brief history about the company. But there are no more details in the history, apart from the fact that you were told that the 2 companies, that is Beta Limited and Gamma Limited, are in the same industry with Alpha. So we can say Alpha PLC is considering acquiring either Beta Limited or Gamma Limited. So Alpha, the introduction can start with by saying Alpha Limited, Alpha PLC rather, is considering acquiring. No, you have 2 companies. You want to acquire only one. Either Beta Limited, or the second company is Gamma Limited. Gamma Limited. If I want to acquire either of these 2 companies, Gamma Limited, 2 companies in the same industry. 2 companies in the same industry with Alpha PLC. So, Alpha is considering acquire is considering acquiring one of these two companies. So, as requested, we have conducted the financial analysis of both companies. As requested, we have conducted a financial analysis of the two companies for the year ended December 31st, 2020. Financial analysis of the two companies for the year ended December 31st, 2020. So analysis have been conducted, financial analysis have been conducted for the two companies to inform the investment decision. That is, we want to use the analysis we have conducted. We want to use it to make the investment decision. So what does this memo intend to serve now? This memo presents our analysis of the financial performance and position. This memo presents our analysis of the financial performance, and position. That is financial position of Bethel Limited and Gamma Limited. And provide a recommendation on which company to invest in, on which company to invest in. Analysis of the financial ratios. The first ratio, no calculation is required, since the calculations of those ratios has been done for us for both Bethel Limited and Gamma Limited. You have the gross profit margin. You know the gross profit margin ratio of gross profit to revenue, and that has been done. We have the gross profit margin of 24.0% for Bethel Limited, and the gross profit of Gamma Limited is 18.0%. So we want to analyze that. So gross profit margin. So, the gross profit margin of since the gross profit margin of Bethel Limited is 24%, and that of Gamma Limited is 18.0%. That shows that Bethel Limited gross profit margin is higher than that of Gamma Limited. So we can start by saying Bethel Limited gross profit margin of 24.0% is higher than Gamma Limited gross profit margin of 18.0%. 18.0%. So what does this imply? The difference in gross profit margin suggests that Better Limited has a more efficient cost management. The difference in gross profit margin suggests that Better Limited has a more efficient cost management system. More efficient cost management system, and it can suggest that they are more efficient in cost management, or a more efficient or a more effective pricing strategy, or a more efficient pricing strategies. So, if you want to learn more about the analysis of financial performance, or how I came about all these findings, I will advise you watch my first video on interpretation of financial statements. So that is for gross profit margin. The second ratio that is provided in this question is profit margin. Profit margin, which is calculated on profit before interest and tax. And you have 19.0% for Beta and 12.3% for Gamma. So we want to report on that. That is the second ratio that is provided. Number 2, profit margin. That is the net profit margin, operating profit margin, which is before interest and tax. So that shows that since it was calculated on profit before interest and tax, that means the profit you have in question is operating profit margin. So if you look at the Better Limited profit margin, you are given that to be 19.0%, and that of Gamma Limited is 12.3%. So the higher profit margin before interest and tax of Better Limited of 19.0% against 12.3% for Gamma Limited suggests that Better Limited is more efficient in operating structure. So we can have the higher profit margin before interest and tax of 19.0% for Better Limited against 12.3% for Gamma Limited suggests that Beta Limited has a more efficient operating structure, has a more efficient operating structure, has a more efficient operating structure and or better cost control and or better cost control. It shows that the management of Beta Limited are better off in controlling their cost. That is the second ratio you are provided in this question. So the third ratio we have in the question is return on capital employed. And you have 62.5% for Beta and 31.0% for Gamma Limited. So we want to report on the return on capital employed. Number 3, return on capital employed. Return on capital employed. You know, the return on capital employed of Beta, which is 62.5%, is higher than that of Gamma Limited. So, the return on capital employed of Beta Limited of 62.0% and 62.5%. Return on capital employed of Beta Limited of 62.5% is higher than the return on capital employed of Gamma Limited of 31.0%. So what does this suggest? So the difference in rows suggests that Beta Limited is more efficient in using its capital to generate profit. The difference in return on capital employed suggests that Beta Limited is more efficient they are more efficient in using its capital to generate profit. In using its capital to generate profits. So that is rows. Then the fourth ratio that is provided in the question is current ratio. Current ratio, we have ratio of 2.4 to 1 and ratio of 1:1 for Beta Limited and Gamma Limited respectively. So we want to report on the current ratio. Current ratio. Current ratio. So what can we say about it? Beta Limited current ratio is 2.4, ratio of 2.4 to 1. Beta Limited current ratio is the ratio of 2.4 to 1, and Gamma Limited current ratio is the ratio of 2.1 to 1. So what does this suggest? Both companies have healthy current ratios. They have both companies have healthy current ratios. Why did I say that? For current ratio, we have the industry average. We have the threshold. The standard of ratio of 2 to 1. That is the normal. As their current ratios meet the acceptable threshold of 2 to 1. Both companies have healthy current ratios as the current ratio of both companies meet the acceptable standard, or you can say acceptable threshold of ratio of 2 to 1. So that is why we say their current ratio are healthy. The fifth ratio is the acid test ratio. We have ratio of 1.6 to 1 for Beta and the ratio of 1.26 to 1 for Gamma Limited. So what can we say about that? Number 5. Acid test ratio. Acid test ratio. So the acid test ratio of Beta Limited is the acid test ratio of Beta Limited is the ratio of 1.6 to 1. Ratio of 1.6 to 1. And Gamma Limited and Gamma Limited acid test ratio is, we have the ratio of 1.26 to 1. Now, what does this imply? Both companies are liquid as they meet the standard of ratio of 1 to 1 for acid test ratio. Both companies, that is the Beta Limited and Gamma Limited, are liquid. Both companies are liquid as they both meet the acceptable standard of the ratio of 1:1 for acid test. So the current ratio and the acid test ratios being liquid implies that both companies can meet their short-term financial obligation. The implication of the liquidity of both companies is that they can meet their short-term financial obligations. So the sixth ratio is net asset turnover. Net asset turnover is the sixth one. And we have the net asset turnover of 3.3 times and 2.5 times. You are to use same definition of capital employed, that is taking as same figures as capital employed. That is your net asset turnover. That is the definition you should use is revenue over capital employed. That is what that implies. And your revenue is already given in the statement of profit or loss, and your capital employed comprises of equity plus debt. And you have been told that your finance lease obligation is a debt. That means it will be included in the calculation of capital employed. So number 6 ratio is net asset turnover. Net assets turnover. Net asset turnover 3.3 times for beta and 2.5 times for gamma. So I want to note that the net asset turnover measures the efficiency of the company's use of its assets in generating revenue. Net asset turnover. Net assets turnover measures the efficiency of the company's use of its assets in generating revenue. It measures the efficiency of the company use of its assets in generating revenue. The ideal standard for net asset turnover is 2.5 times. The ideal standard for net asset turnover is 2.5 times. That is the ideal standard. So the net asset turnover of Beta Limited is 3.3 times. The net assets turnover of Beta Limited is 3.3 times. why Gamma Limited has the net assets turnover VAR of 2.5 times. This indicates that both companies are efficient in using their assets to generate revenue. So since they both have a net asset turnover that is promising the ID standards of 2.5 times, it shows that both companies are efficient in using their assets to generate revenue. Since both companies have the net assets turnover of up to the minimum requirements. Therefore, both companies are efficient in using their assets to generate revenue. Both companies are efficient in utilizing their assets, efficient in using their assets to generate revenue. That is for the net asset turnover. Then the number seven we have after net asset turnover, we have closing inventory holding period. Closing inventories holding period. Closing inventories holding period. So the inventory holding periods as provided in the question. Closing inventories holding period. For beta, we have 31 days and 38 days for gamma. So if you look at the inventory holding periods, Beta Limited has the least inventory holding periods. Beta Limited inventory holding period of 31 days is better than Gamma Limited inventory holding periods of 38 days. Beta Limited inventories holding period of 31 days is better than Gamma Limited inventories holding period of 38 days. So Gamma has the least. The difference in inventory holding period suggests that Beta Limited is more efficient inventory management system. The difference in inventories holding periods suggests that Beta Limited has a more efficient inventory management system. Number 8, we have trade receivables collection period, 31 days for Beta Limited and 47 days for Gamma Limited. So we want to report on that. Number 8, trade receivables collection period. The trade receivable collection period is the average number of days it takes to collect money from credit customers. This is the average number of days it takes to collect money from credit customers. So for this, the shorter, the better for the entity. The shorter, the better for the entity. So Beta Limited has a shorter period of 31 days. Beta Limited has a shorter period of 31 days. I've told you the shorter the better, and it's better than Gamma Limited 47 days, and is better than Gamma Limited of 47 days. So that means the receivable of Beta Limited are easily realizable. So Beta Limited credit policy is better than that of Gamma Limited, because the higher the receivable collection period, the higher the incidence of bad debts. So that means the greater the bad debts. Number 9 is trade payables payment period. We have trade payables payment period using cost of sales. Beta Limited has 24 days payable payment period, while that of Gamma Limited is 23 days. So this one is very close. So you can say trade payable. Okay, now let's have trade payables payment period. Payable payment period shows the average number of days the credit suppliers remain unsettled. So how long does it take you to settle your credit suppliers? This is the average number of days the credit suppliers remain unsettled. So it shows how long it takes the entity to settle their credit suppliers. The longer the period, the better for the entity. The longer the period, the better for the entity. But I want you to know that if you delay the payment of suppliers unnecessarily, suppliers will not be willing to extend credit to you. So they will not be willing to extend further credit to the entity. So that is the implication of you delay the time of settlement unnecessarily. So both companies have similar payable payment periods. Both Beta Limited and Gamma Limited have similar payable payment periods. They have similar payable payment period of 24 days and 23 days respectively. So Beta has payable payment period of 24 days and Gamma have payable payment period of 23 days. This indicates that they both have approximately the same amount of time to pay their suppliers. This indicates that they both have the same amount of time, to pay their suppliers. That is for the payable payment period. Then number 10. This is 9. This will be 10. The 10th ratio we want to consider is the gearing. Number 10, we have gearing ratio. Gearing measures the degree of financial risk the business is being exposed to as a result of how the business are financed. This measures the degree of financial risk the business is being exposed to as a result of the ways the business are financed. As a result of the way or ways the business are financed. The gearing ratio of Beta Limited is 65.8%, while Gamma Limited has a gearing ratio of 64.6%. Therefore, both companies are highly geared as their gearing as their gearing ratios exceed 50%. So it shows that both companies' financial risk exposure is very high. This implies that both companies are exposed to a greater financial risk. Recommendation. Based on the above analysis, that is based on all our findings, we recommend investing in Better Limited. We recommend investing in Better Limited. We recommend that the entity should invest in Better Limited as it offers better return and stronger financial position. Better Limited as it offers better returns. So we say Better Limited offer better returns and a stronger financial position. And a stronger financial position. So that is our recommendation. This marked the end of the solution to the question. Please drop the love emoji, like the video, and also share it with others. Thanks for watching Ezeka.